Hello, we are going to present to you our business plan for our company called Jetstream. Basically, the content of this video is going to take in mind the executive summary, the financial and market performance, our current situation in the market, our marketing strategy, the financial request, the cash flow, balance sheet, and income statement, and our tactical plan. To start with the executive summary, we want to talk about our goal and mission. Basically, our goal as a company is to improve product quality, increase efficiency and production capacity, and expand the market. And our mission is to position ourselves as a leading company in the speed and mountain bicycle market, satisfying our customer needs as well as empowering passionate cyclists with high-tech speed and mountain bicycles, delivering exceptional performance and unparalleled experience. Our strategies start with investment. Basically, investment is to improve key component parts to enhance durability and performance, collaborate with suppliers to optimize processes and materials. Our quality improvement is to implement a new quality management system to ensure consistency and traceability, train employees to detect and correct defects promptly, offer competitive compensation and benefits to incentivize employees. Our capacity expansion. Basically, we have 3 new machines to increase production and we are going to buy another one. In our environmental responsibility, we plan to obtain good neighbor reports to demonstrate commitment to sustainability, enhance environmental impact policies to reduce environmental footprint. And in our market expansion, we plan to hire more salespeople to increase market presence, implement marketing strategies to generate more demand. Our markets are basically Rio de Janeiro, New York, and Amsterdam. And our brands are called Lightning, Pegasus, and Aerodyne for the category of speed. Each of these has a cost of production of $505 for Lightning, $507 for Pegasus, and $513 for Aerodyne. Next, in our mountain category, we have Terra X and Geo X. Terra X has a cost of production of $430, and Geo X has a cost of production of $42.
We reviewed Jetstream performance over the past 3 quarters. In quarter 2, our market share was 10%, while competitors achieved over 20%. Sales were low, but demand was strong, mainly in the speed bicycle segment, which is a really good thing because that is our main target. Also, in this quarter, we launched 4 brands, 2 for speed and 2 for mountain. We sold 118 units in the speed segment with a gross margin of 79,510. The best-selling brand in the segment was Jetstream Light. About the mountain segment, we saw 134 units led by Rock with a gross margin of 68,593. And while these numbers are positive, we really need faster growth. So in the next quarter, we really improve some of these metrics. Now in quarter 3, we can see some little improvements. We successfully increased our market share to 12%. In terms of sales, we sold 365 bicycle units in the 3rd quarter, a significant improvement compared to the 119 units sold in the 2nd quarter. Additionally, our gross margin is higher. And was in this quarter 302,038. While these results are really encouraging, there is still room for some improvement, particularly in the mountain bike segment, where demand was lower compared to the speed bicycle. And it's also important to highlight that despite the growth, we need to enhance our marketing and advertisement strategies to further increase both market demand and sales in the coming quarters. Despite the better sales and gross margin in quarter 3, Jetstream is still operating at a loss of $340,089. So we did reduce some expenses such as the store costs and market research, but overall expenses increased. So moving forward, we really need to control costs and improve marketing to increase demand and reduce losses in the next coming quarters.
To ensure business success and remain competitive, it's essential to develop and integrate a strategy covering key business areas. Each quarter offers an opportunity to refine tactics, optimize risk use, and respond to market demands effectively. This analysis reviews the strategic actions taken by the company over 6 quarters, focusing on marketing, sales channels, human resources, manufacturing, and finance. By examining these decisions, we can understand how they contribute to the company's growth, improve market position, and lay the foundation for sustainable success. In quarter 1, the company focused on evaluating and preparing its operations. It conducts market research, set a budget for test advertising, and establishing an online store along with a presence on marketplaces. The company hired a skilled sales and marketing team and defined its production capacity based on project demand. Financially, it maintained a conservative approach, investing in efficient assets to ensure stability and sustainable growth. In quarter 2, the company expanded its operations by optimizing advertising with more target campaigns and introducing new distribution channels, such as direct sales and affiliates. The sales team received training to boost efficiency and additional staff was hired for case areas. Production was adjusted to meet emergency demand, preventing stock issues. Financially, the company balanced investment in expansion with careful cost management. During quarter 3, the company focused on consolidation and optimization. It diversified promotional content to research new customer segments and initiate to the customer experience online and in stores. Incentivized improved employee retention and organizational culture was reinforced. Production was refined to reduce wastage and increase marginal growth economies of scale. Financial projections were monitored to ensure positive cash flow. Finally, in quarter 4, the company invested in innovation and leadership. It launched innovative products and strengthened marketing efforts to differentiate from competitors. Relationships with distributors were improved, and strategic partnerships were initiated. International leaders were promoted, and retention strategies were reinforced. Technological upgrades in manufacturing ensured competitive, and financial adjustments were made to maximize year-end profits. In quarter 5, the company expanded into geographical markets and intensified its digital marketing efforts to attract a broader customer base. It strengthened partnership with new distributors and boosted direct sales. Specialized personnel were hired to support this growth and optimize process. To meet increased demand, production capacity was expanded with the introduction of new lines. Financially, the company refinanced its operating to ensure a stable cash flow during the expansion phase. Now, finally, in quarter 6, the company launched global branding campaigns to strengthen its position as a market leader and explore emerging markets to ensure a competitive presence. Key talent was promoted to leadership roles, improving retention and team motivation. Producing processes were optimized through advanced technology to increase efficiency. Additionally, a comprehensive financial review was conducted to sustain long-term profitability, adjusting investment and focusing on key growth areas for future success. In conclusion, throughout the 6 quarters, the company implemented strategic decisions that established a strong foundation for growth and competitiveness. Starting with thorough market research and comprehensive financial approach, it successfully expanded its research and adjusted production to meet demand. By continuously optimizing marketing efforts, sales channels, and international process, the company built a robust operational framework. Investments in innovation, technology, and human capital positioned the business as a market leader, ensuring long-term success and profitability.
Jetstream operates in 3 main categories: recreation, mountain, and speed. Each has distinct demand characteristics. Recreation is the smallest segment. Jetstream only has 8% market share here. This segment represents a lifestyle-focused customer base. Our competitors, Gear Up and Fiber Ride, dominate this market. Mountain is a more lucrative category. Jetstream holds just 8% of the market, which is relatively low compared to competitors like Pearlprint with 30% and Secofy with 22%. Speed segment is where Jetstream has its strongest presence. Holding 20% of the market, performance-driven customers dominate this segment, and while we're second to Pearlprint in 48%. Now, let's take a look at the competition. Jetstream operates in a competitive landscape where Pearlprint leads the overall market with a 32% share, followed by Secofy and Europe. Jetstream is trailing behind with only 12%. In the mountain segment, Pearlprint leads with 30%, and in the recreation segment, Europe dominates with 44%. Jetstream limited market presence in these key categories highlights an opportunity, but also a significant challenge. In the speed segment, Jetstream performs relatively better, holding 20%, but still faces strong competition from Pearlprint, which holds 48%. The need to defend and expand in speed is crucial to Jetstream's future success. Despite the challenges, Jetstream has several strengths that we can build upon. First, we hold 20% of the market in the speed segment, a competitive category focused on performance-oriented customers. This shows that we've been successful in capturing part of this high-performance market. Secondly, Jetstream has a strong gross margin of 61%. This indicates that our production processes are efficient and our pricing strategy is effective, even if sales volumes are lagging behind competitors. Finally, the company operates without debt. This provides us with financial flexibility, allowing us to invest in new growth strategies without the burden of financial liabilities. Jetstream faces several weaknesses. The most significant challenge is our limited market presence, especially in the mountain and recreation segments. Additionally, the company has posted financial losses over the last 2 quarters. High operating costs, especially in areas like advertising, are a major concern. These expenses need to be better managed. To end on a positive note, let's explore the opportunities that Jetstream has for the next 3 quarters. First, we can develop new products or marketing strategies to expand into the recreation and mountain segments. There is substantial unmet demand that we can tap into with the right approach. Second, we need to implement cost reductions initiatives, particularly in areas like non-essential or overcapacity costs. The streamlining operation will have improved our bottom line. Finally, we must continue to strengthen our brand in the speed segment by enhancing customer satisfaction and digital marketing efforts. This will allow us to defend and potentially grow our market share in this highly competitive space.
Our company cash flow analysis show a strong trajectory of growth over 6 quarters. We start with a significant cash flow challenges in the first quarter due to the initial expenses and no sales revenue, resulting in a negative cash flow. However, by the third quarter, we saw a turning point with revenues increasing over $900,000 and positive cash flow of $76,807. Looking ahead, revenue is projected to grow steadily, reaching $5 million by the sixth quarter. We have optimized our cost structure and invested strategy in innovation and global expansion, ensuring a robust cash flow and long-term profitability.
Okay, so in the last 3 quarters, we implemented and targeted a strategic expansion plan that drove significant growth across multiple key segments. Our focus was not just on launching new products, but also to carefully positioning them to meet the evolving needs of our market. Now, let me talk to you about our most important highlights that we identify as a business and also of our key drivers of success. In quarter 4, we basically stimulate our market presence. We strategically target 2 potential segments, speed and mountains, and basically the segments represent a diverse range of consumer needs. We successfully launched like 5 brands to cover these segments, each tailored to address specific customer preferences. Lighting, the first brand, is basically a premium brand offering price at $1,570. It is basically a perfect option to choose if you are looking for high performance sports or in bicycle. Pegasus is also a brand implemented or directed for the speed segment. We have Terra X and Geo X, both brands directed for the mountain segment, which basically has a high durability and a very good performance. And also we create a new brand which is Aerodyne. It is a premium brand of this quarter. We offer it at a price of $1,600, designed for the high-end customer looking for the top experience in the speed segment, obviously with innovation. This quarter is very important for us because we expanded our brand portfolio and strategically positioned each product to meet specific market demands. In quarter 5, we maintain our focus on the established brands from quarter 4, allowing them to gain traction in the market. This quarter was less about introducing new products and more about solidifying our presence, focusing on brand recognition and consumer loyalty. In this quarter, we opened a new store in a new global market, which was Rio de Janeiro in Brazil. We didn't decide to offer new products because, as we said before, we was focusing on brand recognition and customer loyalty. Obviously, this quarter was crucial for deepening our market penetration. We focus on expanding our customer base, building a strong brand equity, and preparing the groundwork for the future growth. Okay, so now let's talk about quarter 6. In this quarter, we strategically focus our attention in the recreation segment, recognizing that, okay, this segment is growing up and is basically a very good opportunity for us as a business to go in. So we identified this opportunity and basically we launched for this quarter a new bicycle brand, Joyrider, a brand especially designed for the recreation market. This brand emphasizes on comfort, ease of using, versatility, and basically aligned perfectly with the shift toward more leisure driving activities. Obviously, while the core brands from quarter 4 continue to perform strongly, we added this new brand, Joyrider, expanding our product offering to cater different levels of recreational customers. Okay, we continue to leverage the pricing structure from the previous quarter, ensuring competitive positioning while introducing premium recreational options. Quarter 6 was very important for us because it was characterized by diversification. By expanding into the recreation market, we tapped into a new customer base, allowing us to broaden our revenue streams and establish ourselves as a potential leader in this emerging market segment. Okay, in synthesis, the tactical approach from quarter 4 until quarter 6 enabled us to balance brand expansion with market penetration. We not only diversify our product offering across multiple segments, but also maintain and focus on customer needs, ensuring a strong brand loyalty and market growth. As we move forward, we will continue to identify these insights to further drive innovation and also capitalize on new opportunities. Our company, more than this tactical planning, has demonstrated a unique ability to learn from the challenge and transform itself. A clear example of this is the evolution of our demand projection in the third quarter. By identifying areas of improvement, we strategically invested in expanding our team and strengthening our operational capabilities.
This proactive approach has allowed us not to only exceed expectations but also consolidate ourselves as a more competitive and efficient player in the market. Investors can trust that our company is committed to operational excellence and value creation. Our track record, marked by constant pursuit of improvement, is a reflection of this promise. By investing in us, you become part of an organization that learns from its experience, adapt to market changes, and generate a sustainable change. Thank you.